Today, we're diving into a topic that's crucial for anyone doing business with or in Saudi Arabia: withholding tax. First up, what exactly is withholding tax? Think of it as an advance payment of income tax. When a company or individual in Saudi Arabia pays a non-resident for services, they are required to withhold a certain percentage of that payment and send it directly to the Saudi Tax Authority, which is ZATCA, the Zakat, Tax and Customs Authority. The entity making the payment is responsible for this, not the one receiving it. This system ensures that taxes on income generated within the kingdom are collected efficiently. So, who does this apply to? The key here is payments made from a resident party in Saudi Arabia to a non-resident party. A resident could be a Saudi national, a foreign national with residency, or a company registered in the kingdom. A non-resident is anyone or any entity without a permanent establishment in Saudi Arabia. This covers a wide range of payments, from technical consulting fees and royalties to loan charges and dividends. If you're a foreign company providing services to a Saudi client without having a physical office there, this directly affects you. Now, let's break down the mechanism. How does it actually work? It's a three-step process. First, the Saudi-based payer calculates the withholding tax amount based on the specific service type and its corresponding rate. We'll get to the rates in just a moment. Second, they deduct this amount from the total invoice value before paying the non-resident. So, if the invoice is for 10,000 riyals and the tax is 15%, they withhold 1,500 riyals. Third, the payer must remit this 1,500 riyals to Zakat within the first 10 days of the month following the month in which the payment was made. They also have to file a monthly withholding tax return. It's a strict deadline, and penalties for late payment can be significant, so it's vital to stay on top of it. Okay, the part you've been waiting for: the tax rates. These rates are not one-size-fits-all. They vary depending on the nature of the service provided. Let's go through the main categories. The most common rate is 15%. This applies to payments for technical and consulting services. This includes things like engineering, scientific, or advisory services. It's a broad category, so if you're providing any kind of professional expertise from abroad, you'll likely fall under this 15% rate. Another key rate is 5%. This is a lower rate that applies to several specific types of payments. First, dividends paid to a non-resident shareholder. Second, loan charges, which means interest payments on loans from foreign banks or related parties. Third, rental payments for movable property. And finally, payments for international telecommunication services. So, if your business involves any of these, the withholding tax is a more manageable 5%. There's also a 20% rate, which is the highest. This rate is specifically for payments made to a related party for management fees. A related party means a company or individual that has control over the other, or both are under common control. The tax authority looks closely at these transactions to ensure they are at arm's length, meaning the price is fair and not inflated to shift profits out of the country. What about royalties? Royalties, which include payments for the use of intellectual property like trademarks, patents, or software licenses, are also taxed. These are typically subject to a 15% withholding tax. This is a big one for tech and creative industries. Now, a very important point: double taxation treaties. Saudi Arabia has signed agreements with many countries to prevent double taxation. This means you might not have to pay tax in both your home country and in Saudi Arabia on the same income. These treaties can often reduce the withholding tax rates, sometimes even to zero. For example, the treaty with the UK might reduce the rate on technical services. However, to benefit from a lower treaty rate, the non-resident must provide a tax residency certificate from their home country's tax authority to the Saudi payer. Without this certificate, the standard Saudi domestic rates will apply. Always check if a treaty exists between your country and Saudi Arabia. Let's quickly touch on the filing process. The resident payer is responsible for filing a monthly withholding tax return via the ACCA online portal. This must be done by the 10th of the following month. Additionally, an annual return needs to be filed within 120 days of the end of the fiscal year. This annual return summarizes all the monthly filings. Accurate and timely filing is absolutely crucial to avoid penalties. The penalty for late payment is 1% of the unpaid tax for every 30 days of delay. Let's walk through a practical example. Imagine a UK-based consulting firm. Innovate Ltd provides a market research report to a company in Riyadh for 100,000 Saudi riyals. Since this is a consulting service, the standard withholding tax rate is 15%. That's 15,000 riyals. The Riyadh company will pay Innovate Limited 85,000 riyals. It will then remit the remaining 15,000 riyals to ACCA by the 10th of the next month. However, if Innovate Ltd provides a tax residency certificate from the UK, they might be able to claim a reduced rate under the UK-Saudi treaty, which could be lower, say 10% or even 5%, depending on the specific service classification in the treaty. This would mean more money in their pocket. So, to wrap things up, the key takeaways are: first, withholding tax applies to payments from a Saudi resident to a non-resident. Second, the payer in Saudi Arabia is responsible for deducting and remitting the tax. Third, rates vary from 5% to 20% depending on the service. And finally, always check for double taxation treaties, as they can offer significant relief, but you'll need a tax residency certificate to claim it. Thank you so much for watching. I hope this breakdown made the concept of withholding tax in Saudi Arabia much clearer for you.